Hello, everyone. This is Harjinder. Today, we're going to talk about Chapter 8 for Introductory Management Accounting. In this chapter, we are going to take a look at variable costing and compare it against absorption costing. The learning objectives in this chapter include the ability to distinguish between the concepts of variable costing and absorption costing, to prepare income statements using variable costing and absorption costing, to reconcile the operating income under variable costing and absorption costing, and possibly discussing some pros and cons of the use of variable costing versus absorption costing. Let's take a look at the two costing approaches, absorption costing compared to variable costing. Under absorption costing, all manufacturing costs are considered to be product costs, regardless of whether those costs are variable costs or fixed costs. The manufacturing overhead that is fixed in nature is thus included in each unit of production. So what ends up happening as a result is that the fixed manufacturing overhead gets deferred in ending inventory if it is unsold. Only the selling and administrative expenses are considered as period costs under absorption costing. In contrast, variable costing, which is also called direct costing or marginal costing, considers only variable costs as being manufacturing costs. And it takes the position that fixed manufacturing overhead should not be considered a part of the product cost. Rather, it should be treated as a period cost, i.e., it should be considered to have been expensed every period. Now, how do the two the costing methods, absorption costing versus variable costing, impact operations? Well, firstly, for the managers, the decision makers, the use of absorption costing makes things harder to interpret. Operating income is impacted not only by revenue, but also by production. So there could be an incentive for managers to continue to produce more goods than they can sell, because the buildup of the inventory defers a significant portion of the costs and therefore boosts short-term net income. Under variable costing, it's a lot easier to follow. There is a direct linkage between revenue, sales, and the operating income. Fixed costs get expensed every period, so it imposes greater discipline on the managers as well. It acts as a discouragement for managers to produce more than they can sell. With regards to the use of absorption costing, it is widely used both for internal purposes as well as for external reporting. And it is a requirement for external reporting in the United States. In Canada, variable costing is allowed for income tax purposes. So in Canada, companies can choose either absorption costing or variable costing for income tax purposes. For external reporting, absorption costing should be used. Now, in a typical problem that we will encounter in this chapter, the steps that you should be keeping in mind are: you should begin with a calculation of per unit product costs. for the current and preceding period under variable costing and absorption costing. You should next calculate the beginning and ending inventory in units for the current period. You should then prepare an income statement under absorption costing and an income statement under variable costing. Finally, you will reconcile the operating income under variable costing to the operating income under absorption costing. We will take a look at each of these steps in greater detail shortly. So first up, calculating per unit product costs. So you will take the direct material cost per unit, add to that the direct labor cost per unit, and variable manufacturing overhead cost per unit. These three costs added together will give you the per unit cost under variable costing. If to this amount you were to add the fixed manufacturing overhead costs per unit, you will arrive at the per unit product cost under absorption costing. So essentially, the reason for there being a difference between the two methods is the treatment of fixed manufacturing overhead costs. Variable costing does not include the fixed manufacturing overhead costs as part of the product costs. Absorption costing does. And therefore, the per unit cost under the two approaches differs because of the per unit component of fixed manufacturing overhead. And this is essentially the reason for there being a difference in the operating income under the two costing approaches. Next, let's take a look at how to calculate the inventory in units. So you'll start with the beginning inventory in units for the current month. Essentially, that will be the preceding month ending inventory. To that amount, add the number of units produced in the current period and subtract the number of units sold in the current period. That will give us the ending inventory in units for the current period. Now, this is sometimes, it may not be obvious why we are calculating this, but you will find that this will be a lifesaver in exam situations, because often the inventory units are not explicitly provided. And I have come across many instances of students making errors because they did not calculate the inventory units correctly. Next up, we'll take a look at the absorption costing income statement. It follows the traditional format of an income statement where we begin with sales, subtract cost of goods sold to get gross margin as the difference. From gross margin, we subtract operating expenses to get operating income. Expanded, it looks like the income statement on the screen. Sales, you got to calculate cost of goods sold, where the calculation is beginning finished goods inventory, add cost of goods manufactured to get cost of goods available for sale. And from the cost of goods available for sale, subtract the ending finished goods inventory to get cost of goods sold. And operating expenses are essentially the selling and administrative costs. They could be variable selling and administrative costs, such as sales commissions, or fixed selling and administrative costs, including general salaries, depreciation, office expenses, and so on. Subtracting the total operating expenses from gross margin gives operating income. The variable costing income statement follows the contribution format we learned in earlier chapters, in chapters 3 and 4. And you'll recall that under the contribution format, we begin with sales, subtract all variable costs to get contribution margin. And from contribution margin, we subtract all fixed costs to get operating income. In an expanded form, that's what the income statement under variable costing will look like. So you'll start with sales and then subtract variable costs. The variable costs will include the variable cost of goods sold, as well as the variable portion of the selling and admin costs. Fixed manufacturing overhead will be excluded from the cost of goods sold. That instead will be clubbed together with the fixed selling and admin costs under fixed costs. Sales minus the total variable costs gives contribution margin. Contribution margin minus total fixed costs equals operating income. Now, to calculate the operating income difference, the operating income under absorption costing will be different from that under variable costing unless the number of units manufactured equals the number of units sold. Even then, there is a possibility of there being some differences if the number of units manufactured were not equal to the number of units sold in previous periods. So why? If the number of units manufactured equals the number of units sold, then there will be no difference under the two methods on account of fixed manufacturing overhead costs that gets deferred in ending inventory under absorption costing. So as a quick recap, if the number of units produced equals the number of units sold, you will likely get absorption costing operating income to be equal to the variable costing operating income. If the number of units produced is greater than the number of units sold, then because of the fact that a portion of the fixed manufacturing overhead gets deferred in ending inventory and not charged as an expense for the current period, the operating income under absorption costing will be higher than that under variable costing. If the reverse were true, the operating income under variable costing will be greater than that under absorption cost. To reconcile the operating income under absorption costing to that under variable costing, begin with the operating income under variable costing, add fixed manufacturing overhead that was deferred in ending inventory under absorption costing, and subtract the fixed manufacturing overhead that would have been released from beginning inventory under absorption costing. Remember, the fixed manufacturing overhead eventually has to be charged as an expense. It's a question of when. So under absorption costing, we consider the fixed manufacturing overhead to have been expensed when the goods are sold, right? So inventory carried forward from the previous period will have been sold in the current period. And so the fixed manufacturing overhead that was deferred in the previous period will have been released into cost or charged as an expense in the current period. And so that will have resulted in an additional cost or additional expense booked on the income statement under absorption costing. So basically, two adjustments to variable costing: add fixed manufacturing overhead in the ending inventory, subtract fixed manufacturing overhead in the beginning inventory, and that gives us absorption costing operating income. In class, we will go over two examples. We will go over Java company, and we will go over the example of spinner company. Okay, I look forward to seeing you folks in class when we do these two examples. For now, this is it. This is a short video. Hopefully you watched it till the end, and I look forward to working on the examples in class with you. Thank you.